The animation says this is a breaking news segment here at FreightWaves Now. We'll get into that. First, I want to introduce Zach and Donny Gilbert. So second largest merger in truckload history taking place with the acquisition of US Xpress by Knight-Swift. Start off first by disclosing that our founder, FreightWaves founder and CEO, Craig Fuller, does have interests or own stock in US Xpress through his family trust, but we will have a discussion about this all. Zach, I'll start with you. You see this headline and the acquisition. What are your initial thoughts?
Yeah, I mean, first off, Donny and I have known Craig for a long time now, and it is a bittersweet day for him. I mean, the fact that his family, of course, has had, their founders, longstanding history here. Also ingrained in the DNA of our town here in Chattanooga, US Xpress has seeded a lot of companies, over the years. A lot of talent comes out of that company. So bittersweet day. However, I think, in the bigger picture here, this is actually a really good deal for US Xpress. Now, the fact is they're going to obviously have a little bit of that turnover in the upper levels of management. Replacing CEO and president will be positioned by Knight-Swift, of course. But, big picture here, I think it's interesting to me because it's hard to watch a company, like US Xpress that has such a long history and then just kind of stumble here towards, arguably one of the best freight markets in history. Yep. In 2020, 2021, during the pandemic years, where it looked like you could just have a truck and money would just show up at your door. Yep. So I think breaking down a little bit of the nuance there of what happened and how that can manifest in what looks like such a prosperous time for trucking. Yeah.
Donny, get your initial thoughts before we get into some of the details behind it.
Yeah, I was very shocked when the news came across. We grew up with Craig. This company was part of their family's life, very ingrained. I've got a blanket that says US Xpress, Southwest Motor Freight from back in the early 90s. I've got little red trucks all over my house. And growing up with Craig, it also affected us as well. We would be out in our teenage years camping. Craig was dispatching trucks. He was working for this company and building it. And so it's gut-wrenching, but at the same time, it is a good deal. So it's good for the family, but at the same time, it pains me to see it happen.
Yeah, absolutely. Obviously, the impacts here in Chattanooga are great. So breaking down kind of the details behind the deal. So first one, obviously $6.15 a share, $808 million. So pretty hefty premium to where the stock was trading at close yesterday. But overall, it's about where that long-term average is. The company itself, it's really making a play at newer fleet. US Xpress's maintenance, one of the youngest. Maintenance-wise, it was one of the best. They kept their trucks on the road.
Right.
Right. And that's ultimately one of the most important things when you're operating truckload carriers. You don't want that downtime for your trucks. But then on the flip side, you have Knight-Swift, who obviously has had this history of taking, obviously, the largest merger in truckload history when Knight and Swift merged back in 2017. And you had Swift, whose operating ratio was consistently in the 90s, where you had Knight consistently in the 80s. Now consolidated, they're in the mid-80s. So it's been they have this kind of history of a turnaround. And as you kind of alluded to, it's been almost a stumble over the past few years on the US Xpress side. So it almost makes sense for a company that has experience doing this to come in and make an effort to drive this operating ratio back down into the mid-80s. I think in the press release itself, it says targeting high 80s for the consolidated operating ratio by 2026.
Yeah, and Knight-Swift, of course, has a history of really driving improvement in the operation, and that's what US Xpress needs, obviously. Having a 101 OR in Q4 of 2021 in trucking is alarming, to say the least. And I think, most of the sources kind of point back, and you can kind of see it with the advent of Variant, this initiative that was supposed to be kind of this new revolutionary operating procedure, and it was very hands-off. It was supposed to be very technologically driven, and it just fell flat for multiple reasons. Some of it had to do with, obviously, the transitioning from the old way of doing things to the new way of doing things. I think there was some confusion internally about how that actually should work and should look. Recruiting drivers, obviously extremely important, and not all the time is technology a good route to help you maintain and keep your drivers happy.
Yep.
You really have to be precise when you execute that. And I think that's really obviously what led to the demise here of US Xpress and why they're having to consolidate with Knight-Swift. Now, I think the big picture here, it looks really, I think it looks good. Because US Xpress,
Decline, you kind of fall behind in terms of the rate aspect or pricing discipline, whereas you have a Knight-Swift who has been pretty disciplined overall in their rate side of the business.
I see where you're coming from, but some of these issues started before, and I believe part of that was some issues in the management. We had issues with holding on to some of the superstars. We built Freight Alley, or US Xpress built Freight Alley. These guys came in, they weren't able to keep them. They went out and they built other companies, which eventually became competitors. And an example, I work here at Freightways. I was very in-depth with our customer success. Any local company I called up, I found one of my old US Xpress friends from the mid-2000s that was a superstar then, and that was running one of these companies here now. They lost a lot of their good talent, and then you got a turnover, and it's new talent. And I think it just kind of snowballed. And they got behind on their rates. They got behind years ago. I was brought in to build a new spot rate team to help them get caught up on some of these rates. So these flags have been showing for years, and it's now come to a point.
And this is a point where if US Xpress can keep their maintenance discipline and on that operating side, keep those costs low relative to the entire market, and then bring in the pricing discipline or rate discipline from the Knight-Swift, it's going to be accretive to Knight-Swift's earnings overall because you're getting the best of both worlds in that instance.
Yeah, this is a great deal for Knight-Swift. I mean, arguably. I mean, I know maybe some people on paper might say you're paying a premium, but you're actually getting $2.5 billion of revenue.
Yep.
And you're also reducing the average age of your fleet, which Knight-Swift has been struggling with over the past few years. I believe US Xpress, obviously, Max Fuller wanted to be the Cadillac of truckload carriers. That was the theme. And so he really, during the COVID era, when spot rates are hitting all-time highs, I'm like, that should have been okay.
Yep.
So there's obviously some underlying operational inefficiency there that Donny and I, we both worked at US Xpress for periods of time, him longer than me, and his experience was pretty different than mine, but there were still some of these similarities in terms of operational direction.
Tech developments that can be made, but ultimately the basis of a truckload operation is a truck and trailer have to move goods from point A to point B, and it requires a human still for now, right? So it's you can invest in technology, but it is still a human capital intensive business model.
Oh, 100%. I mean,
They're getting a steal on some of these assets, Tony. Some of these assets, 1.7 was the average age of the fleet.
Yeah.
And also, Tony, look at their trailers. Back in the day, they had issues with trailers that were missing. All their trailers have GPS tracking on them now, and they can tell if they're loaded or not. So if a shipper's trying to hold some of their assets, they can go say, hey, the weight's not, there's no weight on the back axles. This trailer is empty. We need to keep it moving.
Yeah.
And they're getting all these assets in this buy, which is going to really help out their own assets.
Yeah, and we'll bring up a chart here to kind of just show the relative size of this acquisition. I mean, you're talking 7,200 tractors, over 14,000 trailers, 11,000 employees, much of which are here in this Chattanooga area, $2.2 billion in revenue. You look there at the combined entity, you're talking 25,000 trucks, 93,000 trailers, and almost $10 billion in revenue. I mean, it seems like a immediately accretive. I mean, you're looking at least on the revenue side, right? You're able to buy there will be some overlap in terms of that. So it's not a direct one-to-one, but overall, you're getting younger equipment in a time where there still are backlogs from these OEMs. So you have that benefit. You're getting employees that they understand the basics, right? Now you can bring in management and really streamline the process, and you're buying up a trailer pool that's, double the amount of tractors, right? Yeah. So, you're going to 93,000 trailers. That doesn't include the Knight-Swift intermodal containers as well. So, ultimately, it is a massive, massive deal.
And also kind of like, off, the direct, obvious overriding impacts here. One of the big things that's happening, this is consolidation. This is a removal of a competitive entity from the truckload market, and it is a huge competitive entity at that. So this is really a good deal for Knight-Swift in the way that now they've just consolidated one of their bigger competitors.
Yep.
And that's going to, I'm not going to say that pricing power is going to return to the carrier overnight by any means, but it's certainly a huge factor in the way that now you don't have these two mega carriers, and I use that term loosely there, these two big carriers, large enterprise carriers, consolidating their fleets to where they're not competing on bids anymore.
Yeah.
And when you remove, there's arguably, I know that the truckload market is fragmented, 93% have less than 20 trucks in their fleets, but it's really about the top 20 to 30 fleets in terms of size that are really competing for some of the largest amount of freight in the country.
Yeah, when you think about it, you look at the new entrants in the market, a lot of them are on the small end, right?
Yeah.
Whereas you have these legacy plays that have been around for 30, 40 years, but they're the ones that are going to make the big moves. And part of it, and you've seen it happen, because if you look at Knight-Swift's balance sheet throughout the past 2.5 years, they've really been building up this war chest that kind of has given them the ability to go out and make a big acquisition to ultimately set themselves up for success, because inevitably the market will turn. It's just a matter of when does that happen. Donny, you can talk about it. Again, you worked there for some time. It's one of those things, it sets them up for success long term. It's not just hey, let's take out a competitor. It's a way to get in and buy these assets at, I don't want to say a discount, because you look at it, it is a premium to the current stock price, but overall, it brings in a newer fleet that has been well maintained, that, especially when you look at the Knight-Swift fleet that has been aging over the past few years. I think I looked from 2019, you've seen consistent aging of the equipment. It's a lot harder to roll that older equipment out. Now you're bringing in an influx of younger equipment.
Yeah, look at all the struggles that they've seen getting new trucks built, just because of parts issues through COVID. Well, try to get 7,000 new trucks. Now you're not getting 7,000 brand new trucks, but you're getting 7,000 trucks that are near brand new.
Yeah.
And so this will, help with the age of their fleet. Now, are they going to keep all 25,000? I believe they are, and they're going to run this separately. But they're keeping all the employees. There'll be some changes in upper management, and they'll get this. They will get this company straightened out. I worked with some issues there where, as Zach kind of mentioned earlier, maybe some incentives had managers making decisions that made more sense, that helped their paycheck than it was helping the company. I did get in trouble and swapped over to a different division because I told my main manager he wasn't a company man, because I had booked 5 loads for U.S. Xpress trucks that were sitting in Louisville, Kentucky, and he hid them and outsourced them. And because he made better money and it padded his pocket a little bit better. They will fix that.
Yeah. Yeah, absolutely. You look at who Knight-Swift will bring in their executive team to come in and implement the changes that are needed in this instance. And it's one of those instances that it's a big deal, and you're seeing there was change was needed in some extent, because you talked about it, 100 OR in Q1 or Q4 of 2021, which is arguably the best operating conditions of all time. It's quite difficult, especially when you look at Knight-Swift I think they were at 78 in the quarter. So
it's dropping.
very, very big different operating
I mean, that was the golden quarter to perform. And when you can't perform in the best of times and you're at over 100%, then you know when it goes to flip back, eventually you're going to be done. You can't run over 100% forever.
Yep. So, Zach, I'll ask you this and kind of lay out how did we get to this point? The market from 2021 to 2022, now to 2023, you're seeing acquisitions pop up in the market. It is a buyer's market. Obviously, U.S. Xpress has a debt. It has a lot of debt that is coming to maturity later in the year. But again, it's one of those things that now it's the opportunity in the marketplace right now. Capital markets have dried up to an extent, or interest rates, that debt would be financed at a higher rate than maybe what it was before. Now you're seeing this happen a lot more, this acquisition, but none necessarily to this scale. Why? Can it break down the market and how we got to this place and ultimately what it means for the future?
Yeah, so I mean, speaking to the debt, this is a really good win for both U.S. Xpress and Knight-Swift here in terms of they're going to be able to refinance that debt at a much better rate because Knight-Swift's asset liquidity position is far better than U.S. Xpress's. So they're also going to, all of these trucks have revenue assigned to them in some form or fashion. They don't have to go out and grow organically. This is arguably the only way to grow or scale a trucking company is to purchase and consolidate.
Yep.
Because it's hard to have a truck because then you have to go get freight for that truck.
The customer acquisition cost is really high if you're trying to grow it because, like you mentioned, you're buying the asset, you're having to probably find a driver for that, which is the second or the largest expense, and then you have all the fuel and things like that, but that gets into some of the operating. But like you mentioned, it's growing organically is much more difficult or much more expensive, and can you get 7,000 trucks from the OEM on top of what you're trying to turn over at the time?
Yeah, no, and of course the environment that we're in is, we knew there were going to be consolidations this year. We knew that there were going to be, and we still haven't really, we're just in the early stages of what is a down market compared to where it was in, the COVID years. So this is a very unique situation because arguably people are going to be like, this is a down market. How can you go out and buy trucks when freight volumes are arguably, significantly lower? And it's because these trucks already have, it's a 101 OR. You got a couple of basis points away from being profitable. And all that is just finding a 2% more efficiency, and immediately you're making money. And I think just looking at that Q4 OR, even the Q3 OR from 2021 for U.S. Xpress, there's obviously a lot of low-hanging fruit sitting in that operational efficiency. And Knight-Swift obviously is confident that they know how to find these types of things. The one thing I think it'll take a minute. Obviously, the scale of this merger is. That takes time. You got to go in, you got to identify what's going on, how you can integrate quickly in certain areas. And you've got infrastructure that you've got to go in and start kind of piecing together. So it's not going to happen overnight. And I think we're still 4 months away from the closing.
Yeah. So, it's obviously pending SEC, the final approval. And like you meant, that's why they're targeting 2026, right? We're talking 2.5 years, really, 3.5 years. From now till we see that efficiency drive into the high 80s consolidated. Donny, talk about the driver pool overall for Knight-Swift now with this, because you're looking at U.S. Xpress. I think in the last quarter that they broke out variant, you saw driver turnover at 150%. So talk about the driver pool for the combined entity.
I would have first been worried about if you shake up a company like this that you may have drivers disperse. But look at the way the markets have deteriorated. And typically in times like this, if you go back 18 months, drivers could have gone to any company for big bonuses because everybody was trying to get drivers. Well, you're going to see turnover rates on these trucking companies start to drop down because drivers have no place to go. So this is the best time driver-wise to do this because they can't just pack up and leave. Yeah, some might leave, but that turnover ratios are going to drop just simply because the markets, as we go through 2023 deteriorate, and they're not going to be trying to hire more drivers because they're staying in their spots because they can't jump over to a JB Hunt, a Snyder, or a Covenant because that's the typical way the markets work. When it deteriorates, drivers will stay, your turnover ratios will start dropping down. So this is a good time for them to do this. If it was 18 months ago and everybody else was hiring and they said, I don't want to work for Swift or Knight, they could have lost thousands.
Yeah.
So the better timing for this.
Yeah, I mean, this is an area that I look at regularly because it kind of helps gauge the market, is seeing what's like an owner-operator's mindset. And we track that pretty well, and we obviously seen some shifts in that, fastest growth or fastest decline in Landstar BCO, which indicates to us that owner-operators are headed back to company fleets. Well, now you're setting up yourself to bring in, like you mentioned, where they may have gone somewhere else when the market was hot. Well, now your options are probably better put staying back at where you're at, right? Because
Currently, yes.
Because you're going to bring in some of the efficiencies and hopefully, obviously, keep that utilization, improve that overall. I mean, Zach, maybe touch on your thoughts on the driver pool in this base for this acquisition.
I mean, this is the perfect time for driver retention. Mm-hmm. And I think you made a really good point there talking about this isn't like a 2023 deal. Mm-hmm. This is actually a 2024, 2025 deal. Knight-Swift is making this purchase not thinking about, are not overly concerned about turning this thing around on a dime. They'd love to, and I'm sure they'll make their best effort. But driver retention, it's huge when you're talking about this scale of acquisition, because everybody's like, oh man, I'm not working for this company. You know, they were already frustrated, but now their optionality is dramatically limited from where it was about 18 months ago. And I think that is probably a big factor of what plays into this.
Yep.
When you're starting to, decide to make these big purchases, the driver always has an option to just take off. And if they don't agree with, going to work for, whatever company purchases them, they have lots of options. This is a market where drivers' optionality is dramatically limited. And I think for the long run, it also gives Knight-Swift some runway with these drivers. So when the market does eventually turn back in the other direction, which it will, and by that point in time, that means that they've had a lot of extra time with these drivers, this equipment, they've got some operational things in their belt, and they actually have a decent runway because everybody expects 2023 to be a soft year for trucking.
Yeah, and it's not just the driver pool, but I mean, you're looking at trailer pools and like the increased demand for drop and hook from customers, right? Mm-hmm. You've seen growth in trailer pools. We'll bring up the chart here once again that kind of just lays out the scale of this acquisition. And you'll see, I mean, you're talking 93,000 trailers to 25,000 trucks. I mean, you're talking almost 4 trailers to every truck. Talk about, Zach, Donny, either one, both talk about like the impacts of having a trailer pool of this size as now for sure the largest truckload carrier in the country.
You need to turn a trailer 3 times a week. So you can't have too many trailers. You don't want your money tied up in too many assets. Mm-hmm. So as you do these drop and hooks, you want to make sure that you're turning these trailers 3 times a week. If you're not, you need to get that truck ratio to trailer ratio and adjust it a little. And they're not too far out of this. They're 1 to 4. So it's less than 1 to 4. So it's not nothing crazy, but as long as they can manage the trailer pools. I'm curious who's going to see the first blue truck come through Chattanooga pulling a US Xpress trailer. Yeah. It could be very soon. It may not, but typically sometimes that can get out of control too. Depending on how they want to run this, I saw some mergers way back in the day where they're trying to keep their trailer pools separate. When this was back when I was working at US Xpress, and it got out of hand. Mm-hmm. And then all of a sudden, this other company couldn't find any of their trailers at their customers because US Xpress drivers were still in their trailers using those as empties and hauling their freight, and they were getting it got out of hand.
Yeah, and these customer bases are very congruent. Like there's a lot of overlap here. So there's going to be a lot of operational efficiency between the two entities themselves. And when we're talking about trailer pools, Knight-Swift's and U.S. Xpress's trailers sit in the same yards at the same customers a lot of times. So there's going to be a lot of room for them to just kind of consolidate their management of these assets. And drop trailers, of course, becoming a bigger thing over the last couple of years as a lot of these companies, these shippers have recognized the efficiency gained when they can't get capacity. Well, if a company already has trailers in your yard, they're more likely to show up. There's a lot of efficiency there. You don't have to worry about whether or not U.S. Xpress or Knight-Swift is going to come pick up their own trailer. And I think this, even though, maybe it's on a little bit on the high end, but trailer pool growth at its shipper facilities has become more, kind of in vogue.
I guess final thoughts here, just kind of touch on what your thoughts, again, got your thoughts on the deal, but what does this mean for Chattanooga as a whole? Because obviously it's one of the biggest deals to happen, and it's happening right here in our backyard.
I don't think we're going to see a huge effect immediately. Number one, local employees. Everybody's been tightening up on trimming the fat here lately, so they don't have any places to go either. So they're going to stay where they are, but I don't think they're going to make a lot of huge changes that's going to upset these employees. Actually, with the better financing, it might actually take some relief off of these employees. They're not being pushed to their limits every day and worried about, if they break every one of their goals, maybe their goals will come down just a little bit. So I don't think you'll see any immediate reactions here. They look like they're going to run it as U.S. Xpress, just maybe some changes in the upper management. And I think everybody else is going to be solid if they want to stay. I do hope that they keep the fleet young and keep it up to date, like what's been happening over the past 30 years, and keep these trucks on the road.
Yeah, and of course, change is hard to deal with. I mean, there's going to be some churn. There's going to be a little bit of loss here. But at the end of the day, this is arguably the best case scenario for even the employees. I mean, maybe not 100% of them are maybe not going to like it. But I think for the majority, it's actually probably the single best thing that could have happened here, because instead of U.S. Xpress kind of floundering, financially and struggling to get back up, they did not have a lot of runway left after floundering through the pandemic, and the market is down. So they weren't going to get a lot of opportunity to miss. And now they actually have a second life, I think. And I think it's going to work out overall.
Absolutely. Well, gentlemen, thank you so much for joining me on this breaking news. Be sure to stay tuned to freightwaves.com for more coverage of this acquisition. Obviously, a huge deal. But right now, we'll take a quick break, but we'll be back with more FreightWaves Now after this.